Good morning, everyone. Thanks for joining us today. Welcome to the Prophecy Half-Year Results Investor Conference call. We've got all the attendees in listen-only mode now. On the call today, we've got Prophecy CEO Brad Thomas. I'll pass you across in a moment to Brad to kick off our discussion of the company's half-year results. We'll have a presentation from Brad today, followed by an opportunity for everyone to engage in some Q&A. If you'd like to ask a question of Brad during the call, please type it into the Q&A panel in the Zoom app. So to kick things off, I'll hand over now to Prophecy CEO Brad Thomas. Go ahead, Brad.
Hey, folks. Thanks, Tim. Great to see so many people joining the call. That's really pleasing. Looking forward to taking you through our presentation today. What I might do, though, is I might stop my video so that's a little bit less distracting as we move on to the presentation. So let me do that, and then I'll kick straight into the presentation. Right, so you should be seeing the slideshow in front of you, and I noticed many of the names on the attendee list are very familiar, and many of you have heard the story before, but we'll run through the presentation anyway from start to finish, and let's kick off. So, Prophecy International, we are a pure-play B2B software and SaaS company based out of Adelaide in South Australia, although I'm Sydney-based. And we have been operating in the Australian market for a very long time. We'll talk more about that as we go forward. In Australia, we are based in Adelaide and Sydney, and we have our R&D teams in those locations. We also have a subsidiary in the Philippines where we have a pretty large offshore team, mostly tech support, training, some development, some back office. And then we have sales locations in the US, in Denver, in Colorado, and remote in the UK in a number of locations. So as a business, we do more than 80% of our revenue from international markets. And in the last year, we were also the Austrade Advanced Technologies Exporter of the Year, and we were co-winners of that with Audinate. So great to be in fantastic company in that award, and fantastic to have our success in international markets recognised. So typically the markets we sell into, obviously globally, mostly mature economies. I think we've sold into more than 60 countries around the world in the last few years. And we'll talk more about the particular markets as we get through the slides. So as a business, this share price is out of date now, although we've had, which has been fantastic. Our leadership team is spread around the world, both in Sydney and Adelaide, but we also have leaders of the business in Europe and in the US. And from a register perspective, it's roughly a third institutionals, a third insiders, and a third retail. And those numbers move around slightly, but that's a great rule of thumb for the register of Prophecy. So as we continue through the deck, this gives you a good indication of how long the business has been around. As I said, founded in Adelaide in 79-80, listed in 97-98, but the most important dates on this timeline are 2011, where we acquired the Intersect Alliance business, which is the snare business. Emite was acquired in 2015. I joined in 2016, 2017, and took over as CEO in 2017. We had a number of small subsidiaries at that time, including Snare and Emite, and we divested Basis 2 and Primatus and anything else that we could move on, and kept the two businesses with a substantial growth opportunity, being Snare and Emite. And then going forward from there, in 21, we signed Humana, which is our largest SaaS deal with Emite. We've joined Team Defence Australia with the Snare business. We've done record revenue in 22 and 23. We released new product, which is Integration Platform as a Service, on the Emite business in 23. And as I said, we're the Export Award winner for Advanced Technologies in 23, 24. And in the last week or so, we have announced a fantastic partnership with Devo, which we'll talk about in more detail as we move forward. I think on this slide, one of the great things that you will notice is the brand names of our customers and partners. And this is one of the things that really attracted me to the business. 7 years ago when I was looking at joining, and we are incredibly proud of our ability to sign some of the largest customers, partners, and government agencies around the world to our software products. And we are very much focused on that mid to large enterprise, government, military, and defence, depending on the product. So H1 has been particularly good this year. We've had very good top line revenue growth, nearly 30%, 29%. We continue to sign those great blue chip customers that we've just talked about, ATO, Macy's, Schwab, Colonial First State, BAE, Verizon, both government and commercial. We've had really good sales of eMite in the first half compared to the same period last year. And I think particularly we've had great momentum in the Middle East, signing a number of customers there, particularly in the finance and health sectors, particularly with eMite. Snare subscriptions continue to grow, and we do more and more of our kind of run rate sales are now subscription, and we're growing that subscription revenue base quite nicely. We'll talk about the Devo strategic partnership in more detail as we go forward. But pretty much every deal we do on a day-to-day basis is subscription, and then we will sign the occasional large perpetual deal, which kind of blows the ratios out of the water at the moment. But our default setting for Snare now is subscription. And I think the contracted ARR continues to grow to 24.9 million. Invoicing and the cash balance has improved in the first half. We improved our cash balance up to by about $1 million in the first half versus the year before. And I think interestingly, if you look at where cash is now in Q3 of our financial year, we're up from 9.8 to 11.9 million. And we continue to have a very good, strong pipeline. And that pipeline, particularly for Snare, does not really include much of the Devo opportunity. And we'll talk more about that in a moment. eMite continues to be strong, and we're consistently adding new opportunities as deals close on our pipeline for both products. To get to the numbers in a little bit more detail, very good. You can see green on this slide, pretty much across the board. Revenue up 27%, contracted ARR up 21%, invoicing up 21%. Reduced our net profit after tax loss, improved our cash flow position substantially, and the cash balance is consistent with the same period last year. Although, as I said, it has improved in Q3 up to nearly 12 million. And organisationally, we're pretty allergic to debt, so there's no debt on the balance sheet either. So really good improvement this financial year on performance. Very pleasing growth. We're starting to see that contracted ARR flow through into the P&L. And there's also a fairly significant amount in income in advance that will flow through into the P&L in the second half. I think one of the important things to note from our business is that the cash is slightly seasonal. You would have seen that last year. You'll see it this year. Our Q3 invoicing, we have a number of very large customers that are invoiced and pay for their annual subscription for eMite, which has a significant positive impact on our cash balance. And that's one of the reasons why the cash is now up near 12 million. When we talk about the markets that we sell into, we have two very distinct markets with two very distinct products. Although as we move into a cloud native technologies world and start looking at microservices architectures across these two products, you will start to see the two product platforms come together in some way. And there is the opportunity for us to leverage what we're doing with eMite into Snare and vice versa, because at their heart, both of these products are data products. They're about collecting, correlating, normalizing, analyzing, reporting, alerting, and running KPIs and algorithms over data. Just eMite is in the CX contact center market space where we provide analytics around CX, and Snare is in the log management endpoint security market space where we're delivering data into security analytics platforms and keeping data for forensic storage and breach analysis. So both those markets are very substantial. You know, the log management market, which is probably our core market with Snare, is a US $4 billion market and is growing in double digits. And eMite, although many people think of it as a dashboarding and visualization product, really the key to eMite is the ability for us to get the data. You can't analyze the data until you're collecting it properly. And our integration platform as a service is a key part of what eMite does. Along with a number of other technologies, we grab data from multiple different data sources and systems and bring it together for end-to-end customer journey analysis. So very big markets, growing very fast, plenty of upside for us. I think most importantly on the eMite side, the integration platform as a service capability really massively increases the total addressable market that we have in that market segment. And I'll probably touch on that in more detail as we move forward. So this is the eMite product. You know, as we talked about, it's a number of different capabilities. You know, we grab data from multiple sources, and as you can see, you know, with the little cloud here, pretty much any SaaS application that uses industry standard architectures, we can grab information from in a very cost-effective way, and we can bring that into our indexing engine where we can normalize that data and then start visualizing that through our dashboards and reports and wallboards as well in that CX market space. I think the key thing here is really integration of data has become the primary function of eMite. If you think about a typical customer using a number of different systems and applications to deliver customer experience, you know, they're going to have an IVR system, they're going to have a contact center system, they're going to have the CRM system, they're going to have a ticketing system, they are going to have a workforce management system, they probably have chat and chatbots, they have a transcription system, they have a sentiment analysis system, they have a survey system, and very quickly we're up to 10 or 12 different SaaS applications being used to deliver customer experience, a great outcome for our customers. And all of that data today is fragmented, siloed, and disconnected. And our job is to pull it all together, you know, as you see in these diagrams here, to make it available for end-to-end analysis to work out exactly how efficient those systems and people are in that system and how satisfied the end customer is with the experience through the engagement with all those systems and platforms. I think, you know, one of the things we do see is a very substantial cost incurred by our customers and all customers in pulling those systems together. And our job is to solve the integration problem, massively reduce the cost of integration, and massively decrease the time to value in pulling the data together in those systems. Snare is very, very similar, really, in that it's again a set of tools used to pull data from a whole range of endpoints, you know, whether that's desktops, servers, whether those servers are Windows or Linux or Unix or Mac OS X, whether they're network devices like firewalls, switches, or routers. You know, all of those create security events, and Snare is about collecting those security events, sending them through an infrastructure to either our Snare Central product or a SIM product, whether that might be something like a Devo or an IBM QRadar or others in that market space. And the reason you do this is because Snare is a monitoring security solution designed to identify the bad guys once they've got into your network. Very broadly, there are either perimeter security systems designed to keep the bad guys out of your network, and then once they do get in, you have to be monitoring the activity in your network to understand, you know, if you've been breached and how you were breached, you know, what they saw, what they took, what they changed, and how they got in and which systems they accessed. Really, the way I describe Snare is this is the system that enables you to answer the question, how bad is it, once there's been a security breach. And on top of that, there are a number of global compliance mandates, whether that's PCI DSS or the NIST compliance regime, or the ISO 27001, HIPAA, NERC, and others that also require customers to collect this forensic log data, and in some instances store it for many, many years. So things like PCI might be a 3-year storage of that log data, but in some instances, HIPAA can require up to 12 years of log data to be stored and available for forensic search. And Snare enables you to do that, as well as to compress the data, secure the data, orchestrate the data around different systems inside your security infrastructure, and enable things like partners to manage either all or part of your network. Really, the opportunity for us with Snare is to continue our strong footprint in government, military, and defence. We are a solution that was designed by ex-defence personnel in Australia for defence purposes. We are a member of Team Defence Australia, and we do work with a number of defence agencies around the world. But really, the biggest opportunity, I think, is in the partnerships, and we'll talk more about this as we talk about Devo and Carasoft, although Carasoft is also a government, military, and defence opportunity for us as well. And then upselling, more than just the endpoint agents to our customer base, which is both selling Snare Central, which is our forensic storage and analysis platform. But as well as that, we also have very strong value in the enterprise tools space, in that we have a Snare Agent Management Console, which enables you to remotely manage both the endpoint agents and the security policy on all of those endpoints, as well as the Snare Reflector, which is really data orchestration. And there is a very strong value prop for orchestration in the security data space. And we will be putting additional focus on that in the next 12 months, as we see a very significant opportunity to really sell our Snare Reflector as well as our Snare Central capability to our customers. Again, we talked about transition to subscription. Snare has been moving through that transition from perpetual to subscription. And as I said, most of the sales that we're doing today on a day-to-day basis are subscription, with the occasional large perpetual deal, which changes the ratios somewhat, but pretty much every single deal that we do from a default perspective is subscription now, and we're really looking to build that subscription base for Snare in the same way that we have done with Emite. So this gets on to the exciting partnership announcements that we have. So I think the one that we released and updated since January is the Devo partnership. So Devo is a security analytics platform. They provide tools for SOC analysts, security operations center analysts, guys monitoring the network on a minute-by-minute basis, looking for incidents of compromise or potential threats, or remediating breaches. They provide this technology to hundreds of customers around the world. Devo is a key player and is listed on the Gartner Magic Quadrant as a security analytics player. And they have chosen Snare to replace their own internal endpoint agent technology, and they are shutting down their endpoint technology, and that will be end of supported by the 30th of June this year. And Snare has been chosen to replace all that. So we are in the process of migrating every single customer that is using the Devo endpoint technology to Snare. We have something like 30 customers in various stages of deployment at the moment. And if you've been watching our ASX announcement, you'll have seen an update where we have at least $1 million visibility today. And we think that the total addressable market is at least $5 million per annum with the Devo partnership. Interesting to note that there's no real selling motion with Devo. Devo is providing Snare at no additional cost to their end customers, And as each customer gets deployed, we get paid based on the amount of data that we're sending into the Devo platform. That's how Devo charge their end customers, and that's how they're paying us. So this is a new pricing model, but it is subscription for us. And this is effectively a single opportunity that should add somewhere in the vicinity of $5 million worth of ARR over the next 12 to 18 months on the Snare business. So this moves us very quickly into hundreds of customers that we have no engagement with today, as well as driving a very rapid increase of ARR for Snare. I think one of the other areas that we've always had a focus on is in government defense, particularly in the US. And in the last year, we have signed our first distribution partnership with Carasoft. Carasoft is a very large distributor. For those that are familiar with the Australian market, if you're thinking someone like a Dicker Data or a Ingram Micro, Carasoft distributes to downstream resellers, and they have something like 4,000 resellers that support the defense, military, and government markets in the US. And they've agreed to take on Snare as a product to push through their distribution network into government and military. And this is really starting to ramp up. We've established this relationship through our great engagement with Austrade in the US. They've been instrumental in getting us into partnerships like Carasoft. And we see this as a much more leveraged model for us to sell into that government defense market, as opposed to us trying to do that either one by one with partners or trying to do that directly ourselves. So this will be a significant area of focus for us going forward in the US market. And then finally, from a partnership perspective, we talked about this in the past as well. We have signed, we have been invited into the co-sell partnership with Oracle. Oracle is an invitation only for Oracle's most trusted partners. We are the only Australian partner that's been invited into this program. We are one of a handful of partners in Asia Pac, and one of only about 45 partners around the world that are a part of this program. And this is a program where Oracle pays both their sales reps and has an incentive for their partners to resell these co-sell solutions. For me, the best opportunity with this Oracle relationship is really working with the Oracle partners, whether that's their global system integrators or their solution providers or resellers around the world that can bundle Snare and eMight into their own offering and take it into the Oracle customer base or the partner's customer base. This will be a much slower burn than something like a Devo partnership. Oracle is probably not as clean a fit as someone like Devo, but the opportunity and the relationship with Oracle is very significant. We have a lot of support from the Oracle sales team here in Australia and globally, and we see a huge amount of opportunity for us to grow our relationship with Oracle globally and to push Snare and eMight through that channel. So I think to sum up before we jump into questions, I think what we've managed to do over the last 5 years is show very consistent and continued growth in contracted ARR, which is the commitment to either annual or multi-year contracts on both Snare and eMight as we've moved to subscription. I think we've seen good continued growth of actual revenue, P&L revenue, with record revenue in the last 2 years and on track to do that again this year. So I think even over a difficult COVID period and also a period where we've been transitioning first eMight and then Snare into subscription pricing models away from perpetual maintenance pricing models, we've shown our ability to deliver consistent growth. And I think we're very well placed moving forward to really start to get some leverage from the business. Most of our costs are fixed. Really, the only variable cost is some people and some hosting costs, particularly on the eMight business. So we're really expecting to exit this year cash flow positive at the end of 30 June. And depending on how quickly we can deploy the Devo customers, there is the outside chance of a small EBITDA profit this year, but I think realistically, EBITDA profitability is a FY25 target, and depending on how quickly, as I said, we roll out those Devo customers. Both the products, eMight and Snare, have very strong tailwinds. There are continued compliance requirements and increasing compliance requirements for Snare. Customers are increasingly looking to deliver more and more data from their networks and their environments for analysis. We see customers around the globe with very significant blind spots in their networks, and our model enables them to reduce the risk without blowing their budget. So we see a very significant opportunity with Snare. And there are also, we talked about Devo, there are other Devo-like companies in the world that we are very keen to talk to and are already talking to some of those. The eMight business we see going from strength to strength, particularly with the release of the integration platform as a service capability that really enables us to massively increase our total addressable market. Historically, we've stayed very much in the Genesis and Amazon Connect market spaces, but with that capability, we're now talking into the top desk market space, into Zendesk. We're looking at how we work with CX1 and other big vendors in the market to really pull data from multiple systems and enable our customers to manage their customer experience in a much more effective way, and by reducing huge amounts of integration costs. So I think that kind of sums up my presentation for today. Again, we have a couple of very strong revenue streams with recurring revenue coming from Snare and eMight. We have large addressable markets for both products. We're pursuing particularly partnership opportunities on both sides, as well as increased product offerings to address those markets. We're really at that scalable growth and margin expansion point now with both products, and we have a consistent ability to deliver some of the blue chip brand names and names around the world in multiple different geographies, and that's been recognised by the Australian government as an Export Award winner in 2023. So I think that's it from me, Tim, and we might move to questions if that's okay.
Sounds good. Thanks for the presentation, Brad. And thanks for your questions that have come in ahead of time and during the call. Just to remind attendees, if you would like to ask Brad a question, just please pop it into the Q&A panel in your Zoom app. So let's dive into it. Brad, you've spent a lot of the presentation talking about the different partnerships that Prophecy has secured and has had start to flourish. One question that's come in about the Oracle partnership that you updated us on was that the question is whether there's a material margin that Prophecy needs to pay Oracle for securing deals through that channel.
It's certainly not material. This is more about a joint go-to-market approach with Oracle. A large number of our eMight customers are hosted on Oracle Cloud Infrastructure. And obviously, as we sell more, then we consume more Oracle Cloud. So it's in Oracle's interest for us to be successful in market. So it's really about how do we leverage the market together to drive eMight and Snare hosted on Oracle Cloud, which then drives revenue for Oracle. I think generally across all of our partnerships, there is either a partner margin or a wholesale price that we deliver to our customers, our partners, and that may be somewhere between 10 and 30% off our recommended retail price or our list price for both of our solutions, depending on how much the partner is doing in the sales process. If they're, for instance, if they're just identifying opportunities and bringing them to us, they might only get 10%. If they are doing the full sales process, then they might get 30%. But all of the numbers that we report in our financials are net to Prophecy. So it's not like we're reporting $100 and then reporting a $20 margin going back to the partner. In an instant like that, we simply just report the $80 as a net to us, and the margins are really driven by the negotiated wholesale rate that we might give our partner. So you don't really see margins in our P&L because we just simply report, net revenue to the business.
Thanks, Brad. Question on the large US government contracts that we've discussed over the last few periods. Question is, are you closer to securing some of these, and are the existing partnerships helping you to close some of these large US government deals?
So the US government deals, 7 of them are still live. I think we've talked about being in nine of those bids, and 7 of those are still live. 1 is being withdrawn. 1 was awarded to a consortia that we weren't a part of. Quite honestly, if anyone can work out what's happening in the US government at the moment, particularly as it relates to their military spend, then I'd be very interested in the information. Those numbers aren't included in the pipeline. They will be hit or miss. They are starting to get pretty long in the tooth, and if there is a change in government this year, then I think they'll either be refreshed or withdrawn. So I'm not counting on those for success in the business. We continue to focus on deals like working through Carasoft into that market, as well as working with Devo into more commercial markets. What will happen is either those deals will close or they won't. It's completely outside our sphere of influence. The actual sales process being run by our partners as opposed to us. Those are very large bids that we don't have the ability to address in our own rights. That's why we're working with a consortia of other partners, and they'll either close or they won't. And if they close, then we'll get an order for however much money that we bid. But I'm not counting on those closing anytime soon, given the circumstances in the US. And I'm not counting on those for success in the business. If we win any of those, then that'll be the icing on the top, as opposed to something that we need to get us to the growth numbers that we want to get to.
Yep, makes sense. Thanks, Brad. Speaking of success in the business, the question coming about Devo. Can we clarify, we expect Devo to contribute an extra $5 million to ARR this year? Also, is this ARR in addition to what is already recorded in the current snare pipeline?
Yeah, at the moment, the way that I'm reporting the pipeline is the end customers that I have visibility to from Devo. So Devo report that they have 170 plus customers and partners globally, and we're seeing around about an average of, at this point in this early stage, around an average of around about 38,000 potential revenue from each customer. So that's where we get our $5 million worth of ARR from. Now, as I said, Devo are ending support for their endpoint technology as at the 30th of June this year. So it's in both the end customer and Devo and our interest to get that deployed as quickly as possible. So the ARR, the contracted ARR, is effectively there already, but we haven't reported that as part of the overall ARR number. It's in addition to that. And as far as the pipeline goes, there's about $1 million of the $4 million in that pipeline report today.
Good stuff. Thanks, Brad. Can you talk in a general sense about how sticky the customers are across eMite and Snare?
Yes. Okay. So on the eMite side, we've had very little significant churn of customers, unless realistically they've either moved to another CCaaS platform. So a customer might move from Genesis to something else. Let's pick a name, 5nines or TalkDesk or 8x8. And up until now, we haven't had the ability to follow them, not in a meaningful way. However, that's the reason that we've brought the iPass product to market. And the reason the customer gets sticky with eMite is when we start to build very specific reports and analytics for them based on their own business metrics. And then when we start to bring additional data sources in, So when it's not just CCaaS, but it's CCaaS plus service desk, or CCaaS plus external chat, or CCaaS plus their CRM system. The ability to move easily once we're bringing data from multiple systems together, becomes very complex. Most of our customers are large. Their change management procurement processes are complex. So as long as we can provide a decent level of service and value in our analytics, then they're not going to move quickly or easily. And it's similar on the snare side. If we have customers, someone like Charles Schwab, they've got tens of thousands of endpoints being monitored by us. The process of removing our software from all those endpoints and then installing something else is a very substantial project, and probably would take months, if not years. So once we're deployed into an environment, both of these solutions are quite sticky, particularly on the snare side. If we've got snare agents plus the agent management console plus the reflector plus Snare Central for forensics, then obviously the more products we've got, similar to having more data sources with eMind, the more products we've got in, the stickier it becomes.
Sounds good. Thanks, Brad. Can you talk to that new ingestion-based pricing model that is that with the Devo relationship? That's the first time you've been able to roll that one out. Is there much scope for that model to be expanded to other Devo equivalents or other potential partners?
Yes, there is. So typically when we started with Snare, it was based on the number of endpoints that you might have. So a customer might have 10,000 servers, and you would deploy Snare agents to those 10,000 servers, and we would charge you based upon the number of servers that you have. Many of our peers and competitors in the market space charge based upon how much data is collected and ingested into the platform. And that's the way that Devo charge. And to meet Devo's requirements, we have implemented that pricing model. But it is generally accepted in the market, maybe not always appreciated by the end customer, because there's no budget certainty there. The data can fluctuate up and down depending on what's happening in your network or how many devices you bring in from your network. But this is a model where for every terabyte of data collected, we get paid. So it's in our interest to enable our customers and Devo's customers to collect more data from their networks than anyone else can. And that reduces the risk and increases the visibility for those end customers. So yes, that's a new model for us. It's an exciting model, and we are already talking to other Devo-like companies around the world about doing for them what we're doing for Devo. So yes, there are other opportunities using that pricing model globally, and we are very keen to expand our footprint in that kind of through partner model.
Thanks, Brad. So $10 million or thereabouts of cash on the balance sheet at the end of December, which I think has risen in the current period due to the invoicing cycle with some of your key customers. So the question is, how would you like to invest or spend that cash? One investor on the call has asked, would you be exploring a dividend payment? But maybe you can talk about your plans for the use of cash.
Yeah, I don't think there's any appetite to pay a dividend at the moment. When we raised a couple of years ago, we were absolutely thinking about leveraging this for one of three things: growth in R&D, which we have done over the last few years, growth in sales and marketing, which we've done to some extent, but I think there's opportunity for us to do more, and then potential M&A for ourselves. Now, I think the way that the market has changed in the last few years since we did that raise, we're trading at a multiple at the moment that does not make sense for us to go looking for our own M&A opportunities. So basically what I'm looking for is to expand our existing businesses, Snare and eMind, by using some of that capital for expansion. We have done that, but we've also managed to increase the cash flow in the business. I think if you look at the growth we've achieved, even over the last 5 years, we've managed that without really spending any cash. We haven't really burnt any significant amount of cash over the last 5 years. And in fact, we should start to see cash increase going forward as we start to get leverage into the business. So at this point, we're kind of keeping our M&A powder dry, and we will continue to expand both the snare and e-mite businesses to meet the market opportunity. For instance, my snare team in the US is pretty much fully utilized addressing the Devo opportunity at the moment, but there are other things in the market we need to do. So, I'm definitely looking at expanding our sales organization in the US for snare, for instance. And cybersecurity salespeople globally are not cheap resources at the moment, and not easy to find. So, we'll continue to use that funding to expand our existing business rather than anything else at the moment.
Good stuff. Thanks, Brad. So just another question, diving deeper on the use of cash or the cash balance expectations going forward. So the question is that you mentioned as of Q3, the cash balance has grown to 12 million. Do we expect this to grow or stay flat or decline throughout Q4? And follow-up question from that, how much do you expect costs relative to revenue growth to evolve in the years ahead?
Yeah, look, I don't expect a huge amount of additional revenue growth in that's not revenue, a cash growth in Q4. That should stay flat, but enable us to be cash flow positive for the full financial year, depending on how quickly we roll out the Devo customer base. And obviously, the more quickly we roll that out, the more quickly we collect the cash. So, that's kind of the variable in the cash number in the rest of this fiscal year. From a costs over time, if you look at our costs, generally the most significant cost in the business is people, and that will continue to expand particularly as we increase our sales and marketing capacity more than anything else. I don't have huge plans on increasing our R&D capacity in the short term, and I think any increase wouldn't be material or significant anyway. It's really about getting the right people with the right skills to deliver the right projects as we identify those. The other costs are our internal systems, both hosting and applications. They are pretty much a fixed cost. They don't really scale with revenue, but the hosting of our customer environments, particularly for e-mite, that does scale with revenue. E-mite's currently got gross margins of around about 85%, and with hosting cost equivalent to about 15% of revenue. We are looking at ways to reduce that. My target is to get that to about a 90% gross margin, which I think we're capable of doing over the next 12 to 18 months with some changes to the architecture of the e-mite product. But really, that's the only thing that scales with revenue growth. Obviously, as we sign more customers, then we need a larger support team, but most of that is done out of our Philippine subsidiary with lower cost resources in Manila. So that's realistically the outcome. I think we're at a point where we should be able to generate both a increasing cash balance and increasing EBITDA going forward into FY25.
Excellent. Thanks, Brad. Just coming to the last couple of questions from attendees now. So if any other investors have questions for Brad, please pop them in and we'll get to them. The comment's been made appreciating the Prophecy releases quarterly reports, which is, I think, over and above what the company's required to do by the ASX. Yep. The question is, can you give some guidance on timing in terms of when you plan to release the Q3 income or financial figures?
Yeah, after the end of Q3, basically. It'll be sometime in April. And typically what we'll report is sales performance, net new contracts, and growth of contracted ARR, as well as cash. Typically, we don't report revenue at that point because we're not required to under regulation and obviously running a relatively small business our resources are pretty fully utilised at the best of times. So we'll continue to do the reporting that we're required to by the ASX, and we'll report really sales performance at the quarter.
Yeah, I think that makes sense. And I think previous Q3s for the last couple of years, I think Prophecy's released it in sort of the second week of April, so that should be probably a reasonable expectation, I would think. Another question, is there any thought given to an on-market buyback of shares?
I think one of the challenges that the business has on the market is our liquidity. So for me, any thought of a buyback would only decrease the liquidity that we have on market, and there is no thought of doing a share buyback at this point.
Makes sense. Thank you. So just another question back on Devo. Can you tell us some of the things about Snare that prompted Devo to choose Snare to partner with over other competitors of yours?
Two primary reasons. First and foremost, our endpoint agents are the best in the market by a long way. They're both small and use very little resource on the end customer's endpoint. Obviously, you don't want to be putting an agent on a server and then having that server performance degrade as a result. So that's one reason. The second reason is that we can scale probably better than anyone else in the market. This is one of the reasons why IBM uses us for some of their largest and most complex customers, is because we can scale to thousands and thousands, if not hundreds of thousands of endpoints. We're very easy to deploy. Snare's design principles are all about abstracting the complexity for the end customer, making it easy to deploy, easy to maintain, and reducing the number of skilled resources that you need to manage that environment. And I think the last thing is because we have a very substantial agent management capability, which enables you to remotely manage all of those agents without touching the endpoint, including managing the security policy on all of those devices. So that's really the reasons that Devo chose us.
Excellent. Thanks, Brad. And I think you touched on this one earlier, but just any further comments on other Devo-style relationships that you're working on for this year or next year? Would they be similar size in terms of opportunity and the ease with which you could achieve the sale?
Look, there are other companies out there that are similar to Devo that we're talking to. I don't think it's appropriate to talk about either the potential timing or size of those at this point. We're in early stage conversations with a couple of companies, and we are pursuing those opportunities, but there's no real information to give an update on timing or size.
Yep, no problem. So just to the last question that's come in for the time being. So with the share price up 40%, I think it is in the last 3 months, naturally Prophecy's now in front of in front of the eyes of some new investors. Can you point out some of the key near to medium term value catalysts that that we should be looking to over the next few months on both sides of the business?
Look, I think on the Emite side, it's our ability to massively increase our addressable market using the integration platform as a service product. I think if we look forward another 12 months, the makeup of our customer base should change significantly. We've been very much working in the Genesis and Amazon ecosystems, and we can now spread our wings away from those two ecosystem partners to other partners. We talked in the AGM presentation about the big talk desk implementation that we're just currently wrapping up in Europe with Just Eat Takeaway, and once that's done, then we'll be pursuing integration opportunities in other markets pretty aggressively in FY25. And on the Snare side, it's our increased focus on things like the Snare Reflector, as well as other partnerships like Devo in FY25 that will enable us to grow, very, very substantially faster, which should enable us to, again, gain leverage in the business across both products with those two areas of focus.
Thanks, Brad. Lots to look forward to there. Just a few more that have just dropped in question-wise. Just diving deeper into the Devo partnership, are you able to talk to the pricing discount that you might have given them relative to normal pricing, and also any details on the margin structure that you expect to extract through the partnership?
So no, I'm not going to talk about the pricing discount that we gave them. Apart from to say that we gave them a discount commensurate with the volume and the term commitment that they've made to the snare business. And for that business, it's effectively 100% margin, because the customer is deploying the snare agents to on their endpoint devices, when they're deploying the snare agent management console inside their network environment or inside their own private cloud environment. We're not hosting that at all. So effectively, 100% of that revenue falls straight through to the P&L, and provided we're meeting our fixed costs, it will go straight through to the bottom line.
Good stuff. Thanks, Brad. And just back to the Emite business, at the half year, we did point out some momentum in the Middle East with customers on Emite. Can you talk to the opportunity that you see ahead in the Middle East following those recent wins?
Yeah, so I think we've established a fairly strong position with Emite in the Middle East. Really, what opened up that market was companies like Genesis and Amazon and Oracle having in-country infrastructure, and to enable us to meet the data sovereignty requirements of companies and agencies in the Middle East. Obviously, they have regulation that restricts their end user data from leaving their countries in the Middle East, whichever the Emirates that might be in. So our ability to address that market was opened up relatively recently by our partners, and we've established a very good leadership position with a number of significant companies in the Middle East. So yes, I think there is definitely more opportunity there, and there's more opportunity in the pipeline.
Thanks, Brad. That's all the questions that have come in from attendees for now. So I think we'll draw things to a close there. So on behalf of Prophecy, I'd really like to thank everyone for tuning in. We appreciate everyone taking the time and for your continued interest in the business. If you do have a question we didn't get to today, please reach out to either myself or Brad. Management will be happy to discuss it further offline. And we will also make the video recording of this session available online at the Prophecy website and on the NWR Communications YouTube channel. We're looking forward to the opportunity to talk to you all again soon. And Brad, I might pass back to you across for any closing comments.
Thanks, Tim. And look, I think it's really just thank you to everyone who's attended the call. I see a lot of familiar names there, which is fantastic, and a few new ones. As always, we're really grateful for your interest in the business. And as Tim said, if there's any further questions, please feel free to throw me an email. My contact details are up on the slide you can see now. And we're looking forward to closing out a successful FY24 and to the opportunities in front of us in financial year 25.
Excellent. Thanks, Brad. Thanks, everyone, for joining us. We'll chat to you again soon. Cheers.